Real estate never goes down. Stop paying your landlord's mortgage. It's a self-liquidating asset. If you live in the Philippines, you've heard these lines 1,000 times. Maybe it was a sales agent at a mall, or maybe it was your parents during Sunday dinner. In our culture, owning a condo is treated like a rite of passage, a sign that you finally made it. But here's the cold, hard truth. A condo is a financial tool, not a trophy. And right now, thousands of Filipinos are property rich but cash poor, tied down by monthly amortizations for a unit that isn't actually making them any money. Today, we're stripping away the marketing fluff and looking at the raw numbers. Is a condo actually a good investment for you, or are you just buying a very expensive hobby? In 2026, the average gross rental yield for condos in the Philippines sits around 5 to 6%. Sounds decent, right? But let's put that into perspective. Here's the catch. Gross yield isn't what you actually pocket. Between property tax, association dues, repairs, and agent fees, you're losing 1.5 to 2%. That shiny 6% gross yield, it's more like 4% net yield once reality kicks in. And that's before you factor in vacancies. High-end condos in Makati or BGC usually give you 4.5 to 6% gross yield. But because the purchase price is sky high, your returns feel smaller. Mid to low-end condos, on the other hand, can push 5 to 7% gross yield. They're cheaper, easier to rent out, and often give better cash flow. Translation? Luxury condos are like Arizal-like designer bags. Great for flexing, but not always the best for ROI. Now let's zoom out. Singapore, 2 to 3.5% gross yield in prime districts. Thailand, 4 to 5.5%. Phuket short-term rentals, up to 8%. Indonesia, 6 to 12% gross, but net drops to 4.5 to 8% thanks to seasonal vacancies. Vietnam, 4 to 6% gross. Cambodia, 5 to 8% gross. So, the Philippines at 5 to 7% gross is competitive, but not the highest. And again, net yield is what matters. Let's talk about the money you bleed every month. Association dues, 50 pesos to 100 pesos per square meter. Property tax, about 1% annually. Repairs and maintenance, 20,000 pesos to 30,000 pesos a year. Broker fees, 1 month's rent every time you get a new tenant. Vacancy costs, expect 1 to 2 months empty per year. Suddenly, that passive income doesn't feel so passive. Here's the kicker. You can get similar returns without the headaches. MP2, 6 to 7% annual dividend, government-backed. Real estate investment trust, 5 to 6% dividend yield plus liquidity. Dividend-paying stocks or funds, 4 to 6% yields with growth potential. All of these options give you condo-level returns without dealing with tenants who think paying rent late is a personality trait. Before you buy a condo for rental income, ask yourself, is the location in high demand? Who are your tenants? Expats, students, BPO workers? What's the vacancy risk in that area? Can you afford the liquidity risk if you need to sell fast? Are you chasing appreciation or cash flow? If you don't have clear answers, maybe the condo isn't the right move. So here's the bottom line. Condos aren't a one-size-fits-all investment. High-end units are safer but yield less. Mid-market units give better cash flow but require more effort. And alternatives like MP2, real estate investment trust, and dividend stocks can match or beat condo returns without the stress. Don't buy a condo just because your parents or friends say it's the best investment. Crunch the numbers, compare the options, and invest where your money actually works hardest. Thanks for watching. If you found this breakdown useful, hit like, subscribe, and share this with someone who's about to sign a condo contract without reading the fine print. See you next time.